Hi, this is Vinay Sharma. I'm part of the equity fund management team at Nippon Life India Asset Management Team and manage various schemes, including Nippon India Focused Equity Fund, which we are discussing today. In the last 1 year, we have seen all kinds of emotions in the market, from despair at the beginning of the recovery in the last to recovery in the last 2-3 quarters. During this period, Nippon India Focused Equity Fund has generated 68.36% returns for its investors. While reiterating that past performance is not indicative of future returns, let me talk about the overall contours and of the fund and its strategy. This is a flexi cap concentrated and focused strategy. Being flexi cap in terms of market capitalization, we run the fund at 55 to 75% large cap and 25 to 45% in mid and small caps with a maximum of 30 stock positions. That means that there is a core of the fund in terms of large caps, and then there are satellite positions in scalable mid caps. Focused approach could manifest itself in sizable positions in some themes or sectors, and at some other times it could manifest in terms of high percentage positions in bottom of stock opportunities. We would like to believe that there is a likelihood that it's a combination of both at most points of the time. The philosophy of the fund is to invest in companies where we see significant value creation potential and scalability over the medium term. That potential could be due to higher growth potential of the sector or the company, or it could be due to company sector being in temporary down cycle resulting in depressed valuations today. It could be due to company investing in a new technology product that holds significant potential if successful, or export opportunity as the company gains scale. The point I'm trying to make here is that we are not constrained by growth at reasonable price or value philosophy. We believe that markets at various points of time gives different sorts of opportunities, and we would like to take advantage of those opportunities irrespective of the nature of it. Given the concentrated nature of the fund, there are some other peculiarities of this fund. One of them is the fund does have a good representation of focus stocks that may have higher than market growth potential. Since the benchmark has 500 companies and the fund is maximum 30, it's not very benchmark centric, and the top 5-6 positions make about 35 to 45% of the fund at most points of time. This also means that some themes which we are bullish on could form sizable part of the portfolio. As mentioned earlier, we focus a lot on scalability of our investments, so that becomes a very important part of the company sectors we invest in. We believe that today financials, technology, consumer, manufacturing, auto, and export-oriented sectors are some of the key areas that fit this criteria. We also try and identify companies with technology edge even within these sectors, as increasingly technology edge is becoming a key mode within sectors, and such companies do tend to have higher probability of non-linear growth. Now let me come to the current positioning of the fund and how we are thinking about markets today. On the overall macro, we believe that after the COVID shock, world is entering a phase of synchronized recoveries in most large economies, including developed and developing ones. The other big change COVID has brought is synchronized fiscal and monetary easing in the world. Due to these, we believe that the world growth may remain strong over the coming quarters. In 2-3 quarters, a large part of the developed world could get vaccinated, and this could bring down virus risk as well. Key risk to our thought process could be virus rates in developing countries, which are far behind in their vaccination drive. If there is a considerable gap between pace of rebound in Western world versus emerging markets, that could have implications on fund flows towards emerging markets, including India. On the domestic fund front, we are optimistic on banking system, credit growth, asset quality recovery. And given our worldview, we are also inclined towards companies that benefit from synchronized recovery in the Western markets. Given this background, sectors or themes that form sizable part of our current portfolio include large banks, which may gain market share, where we believe asset quality may surprise positively, and which have the technological edge to handle any emerging disruptions in financial sector. This also gives a bit of cyclical color to the fund, as we are sanguine about macro recovery. The next big theme in portfolio currently are new age technology companies, which may show non-linearity in growth over the next few years. These companies could be in various sectors such as software, financial, telecom, retail, travel, etc. But technology is the glue that binds the thought process behind these investments. Companies which may benefit from opening of the economy and mobility a few quarters later also form some part of the portfolio. To complement this, some plays in sectors such as commercial vehicles, logistics, which again benefit from global recovery as well as opening of domestic economy, are present in the portfolio. On the underweight side, we are cautious on sectors which we believe are expensive today and may not benefit much from demand recovery, such as consumer staples, traditional pharma, etc. We also generally try to stay away from companies where technological disruption can lead to question marks over terminal value and long-term growth, such as traditional media or commodity plays, particularly in the energy sector. Overall, to summarize, we believe fund may be well positioned to benefit from growth recovery in most economies. That's it from our end. Stay safe, everyone. Thank you.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.